Welcome everyone to today's Advanced Audit Assurance and Forensic class. Today, we are going to be looking at planning, chapter 7. So you can open your textbook to chapter 7. And also, I hope you came with your notebook because my notes is also, lecture notes is here, so I can, like the way we normally do it. So you can also take down notes as well. Now, I want to start today's class by telling you something that nobody tells you before you begin this career. When I finished university, I was excited. I had my degree, I had my books. I thought I understood accounting. I thought I was ready. Then I got posted for NYSC to a small, or let me say a large audit firm in Abeokuta, Benga Adeoye and Co. Chartered accountants. So you can see that when it comes to this aspect of audit, Benga Adeoye and Co. Chartered accountants. Many of you might be familiar with the organization. It's an organization I respect so much after being opportuned to have been posted for NYSC there. So this was the organization. It's still over there in Abeokuta and other locations. Now, within my first week, I realized something that my university education had never quite prepared me for. And that was something I hold because I realized that there is a gap between knowing accounting and doing audits. So I realized the gap between knowing accounting and doing audits is enormous. Now, let me tell you from some experience what my first audit experience actually looked like. What we call audit engagement. We had a client, because this topic on planning has a lot to do with audit engagement. Now, we had a client, a trading business in Abeokuta. The engagement senior handed us a set of files and said, start vouching the expenses. So I did. I sat there for hours. Ticking invoices, comparing figures, checking arithmetic. And I was very thorough, very detailed, very proud of myself. At the end of the day, the engagement senior reviewed my work, nodded politely, and then asked me one question. A question I was not prepared for. He said, Williams, before you started testing those expenses, did you understand why those expenses existed? Did you understand this business well enough to know which expenses were risky and which ones were not risky? I did not have an answer because the honest truth was I had walked into that audit room and started testing without a proper plan. Testing without first understanding the business, without assessing where the risks actually were. I was doing what I felt like audit work, but I was not auditing strategically. I was auditing randomly. That senior taught me something that day that no textbook had spelled out clearly enough. He said, Williams, an auditor who tests without planning is like a doctor who prescribes medicine without first examining the patient. He said you can work very hard and still miss the diagnosis. He told me that in audit, working hard on the wrong things is the same as not working at all. He told me that the plan is not the paperwork you do before the rework. The plan is the rework. Everything else you do in the field is just execution of the plan. I never forgot that. And from that moment in Abeokuta, I became obsessed with planning, not because it was required by ISA 300, but because I had seen with my own eyes what happens when you walk into an audit without one. And that experience launched a career that eventually took me out of the audit firm and into consulting and financial training, which is where I am today, standing in front of you. And the reason why I started with that story is this. Every single concept we are going to cover in this class and also all through the Advanced Audit Assurance and Forensic class for professional level, every ISA, every framework, every formula is the professional codification of the lesson that senior taught me in Abeokuta. ISA 300, which we'll also look at, is not a bureaucratic requirement. It is the formalization of the wisdom that experienced auditors have been passing down to juniors for decades. I hope we understand. Planning exists because hard experience showed the profession that audits done without a plan produced wrong opinions. And wrong opinions destroyed businesses. Wrong opinions destroyed careers. Wrong opinions destroyed firms. So when I am teaching here in Miramore Institute on these professional courses, when I'm teaching here, I'm not just going to teach you how to fill in an audit strategy memorandum. I am going to teach you how to think like a planner. And that thinking, when applied correctly in the exam hall, is what separates candidates who pass from candidates who wonder why they keep failing. Now, let me quickly do something deliberately. I'm going to take 4 things I experienced early in my career, starting from Gbenga Adeoye and Co., and show you exactly how each one maps to a topic we'll cover in this chapter today. Because I want you to understand that what ICAN is asking you to learn is not theoretical. It's because most times when new students comes to class, you believe it's not theoretical. It is documented professional wisdom. In our lesson today, we'll be looking at different type of risks. For example, inherent risks, control risks. Inherent risks. Now, from my field experience in Abeokuta, some clients were trading companies importing goods, and their inventory was always the riskiest balance. Most times, values fluctuated with exchange rates. Goods could be damaged in transit, and counting was also chaotic. So, by what we are going to be learning in today's lesson, especially ISA 315, inherent risks, you will understand the nature of a client's business creates risks that exist regardless of controls. So the auditor is expected to identify and respond to them in the plan. Very important. Now, another risk aspect is control risks. From my field experience back then, one client had a cashier who was also the person approving payments and updating the ledger. 3 jobs, 1 person. Classic segregation of duties failure. And at the end, we found fraud. So part of what we are going to look at in this lesson today is ISA 315, control risks. Now, when internal controls fail or are absent, the risk of misstatements surviving into the financial statements rises sharply. So the auditor must assess controls in planning. Very important. From my field experience, another area is on the aspect of materiality. I remember I once spent half a day investigating a 12,000 naira discrepancy in petty cash for a client with 300 million naira in revenue. And my senior almost laughed. He taught me to always ask, would a reasonable investor care about this figure? You see that question? That question is materiality. And today's lesson will also ponder on materiality in respect with ISA 320, where the auditor sets a threshold below which errors are not worth investigating. You must know that time is finite. Materiality focuses audit efforts where it matters. From the field experience, detection risks is also another important aspect, which this very chapter also covers. I could remember I once gave a clean opinion on a payroll system, but I had only tested 1 month's payroll. Ghost workers existed in the other 11 months. My testing was too narrow. My detection risk was too high. So in this lesson, prepare your mind because we'll look at ISA 330 in respect to detection risks too, because the auditor controls detection risks through the extent of testing. Narrow testing equals high detection risks. The audit risk model tells you how much testing is enough. So this is very important because everything I've just talked about happened before I was even a qualified accountant. It happened during NYSC, and it is all in chapter 7 of your ICAN approved textbook, which tells you something important, right? So when you come to class here in Miramore Institute, you're learning from experienced instructors. Now, let me be honest with you because I respect your time. I respect your investments in this program. Some of you in this room are practicing accountants. You prepare financial statements, you manage accounts, you may even supervise junior staff. And when you hear words like audit risks and materiality, part of you feels you already know this. I want to challenge that assumption today respectfully. Now, in the ICAN AAF exam, candidates who work as practicing accountants fail this topic more often than candidates who do not. The reason is because they confuse doing accounting with auditing accounting. They know the numbers, but they struggle to identify the risks in those numbers. They understand controls, but they cannot link a control weakness to a specific financial statement misstatement. A financial statement misstatement. They have heard of materiality, but they cannot justify a materiality threshold under exam conditions. The examiner does not want to know that you know what inherent risk is. The examiner wants you to look at a scenario. Let's say a scenario about Silvergate Pharmaceuticals or Zenith Constructions and identify the specific risks that are there and also link them to specific financial statement items. The examiner wants you to look at a scenario and justify materiality figure and also outline a plan of action. And that is what today's class is about. And if you stay focused for the next few hours, you'll be able to do exactly that. You'll be able to do exactly that. So let's bring out our notes. I'll also bring out my notes. My lesson note is already here. So I'll share it on the screen and let's take down notes. Let's look into this topic properly. Okay, so welcome to AAF class. So we are looking at planning. Now, before we begin, I want you to put down your pens for 2 minutes and think about a question I want to ask. Can you hear me? I want to ask a question. You know, we are in audit class. We need to act as auditors. Can you hear me?
Yes, sir.
Now, imagine you are the senior audit manager at a Big Four firm in Lagos. You know, when we mention Big Four now, you know the Big Fours.
Yes. The
Mention one.
Deloitte, KPMG,
Exactly,
the
correct.
Deloitte, KPMG, PwC, and Deloitte.
So imagine you happen to be the senior audit manager in one of these Big Four firms in Lagos. Then one day your partner walks in on Monday morning. Tomorrow night is Monday. So your partner walks in and says, "We just signed Dangote Cement as a new audit client. We just signed Dangote Cement as a new audit client. The engagement partner is traveling. You have 3 weeks before field work begins." What do you do first?
Okay. As a senior auditor on the engagement, so first thing I will do is to start with planning. Like I will meet the finance team to understand the business. They should tell me what and what the business is into, the environment. Then I will ask about the controls that was putting in, maybe in the payment, in the authorization of payments and the likes. If there is a separation of duties, like the person that is making the payment is not the person that is approving it. I'll first ask about the planning, then the control, before other substantive testing, before going to vouching of records and the likes.
Are you done?
Yes.
Good. You know, I heard response like planning, reviewing last year's audit file. I heard you talk about meeting the clients too, right? Maybe you meet the client's
Yes.
finance director,
Yeah. So,
understand the
yes.
business. You mentioned understanding
Mhm.
the business. You check for independence. You see all of
Yes.
this, all what you mentioned, eh?
Yes.
All of them are planning. So what you just did in 90 seconds is exactly what another standard we call ISA 300. This is exactly what ISA 300 requires you to do professionally. And we will look at it, don't worry. That's what it requires you to do professionally, systematically, and documentably. So Today, we are going to take what your instinct already knows. See the way you already know it now. We are going to take
Mm.
it and convert it into the framework that ICAN will test you on. And by the end of the class, trust me, when you come across any planning question or risk question, because you have been prepared to think the way the examiner expects you to think, you will not lose a single mark on it.
Okay, sir.
So when you go to the study text here, when you go to the study text, there are a lot of learning objectives that have already been highlighted here. I believe you can see it. Can you
Yeah.
see the objectives? Let me share the screen completely so I can navigate.
Okay.
Can you see my screen?
It's coming up. I can see it.
Okay. That means you did not see when I wrote this ISA 300 before.
No.
Okay. So for the learning objectives, by the end of this session, you will be able to describe how to plan an audit engagement in accordance with ISA 300. And you will also be able to identify and explain and apply, because we actually have three components of audit risks. Don't worry, we'll give you notes. Three components of audit risks when you reach time to write. I'm just mentioning it.
Okay.
So what I expect from you by the time we are rounding off this class today, I will ask you about them. One is inherent. The second is control. The third is detection. So I expect that by the end of this class today, you should be able to identify, explain, and apply the three of these components: inherent, control, and detection. And you should also be able to link business risks to financial statement risks. And that's one of the favorite aspects for me here, linking business risks to financial statement risks. Then should also be able to apply materiality principles under ISA 320, which includes performance materiality. We have the aspect of computer controls. So we should be able to evaluate computer controls in a computerized audit environment. There is a framework we call COBIT, C-O-B-I-T. So I also expect that you will be able to apply the COBIT framework to IT governance and audit as well. And also you should be able to, you can see the aspect of not-for-profit organizations, right? You know what
Yeah.
they are now, NGOs. But here now we'll call this
Yeah.
one NFPOs. So you should be able to describe the special features of auditing not-for-profit organizations. Because when we audit not-for-profit organizations, there are special features for doing that. Then there is another aspect of sustainability assurance, which is under ISSA 5000. So you should also be able to discuss that sustainability assurance under ISSA 5000. Now, let's look at the foundation. Okay.
Okay.
Hello.
Hello, I'm with you, sir.
Okay. So let's look at the foundation so we can understand what's actually this actually about. And to start with, let's get to know the objective of an audit. Why do we plan? Why is planning important for auditors? Now, before we can plan anything, we must know what we are planning for, is it not?
Yes, it is.
What is the auditor trying to achieve? You see this standard called ISA 200? It
Mm.
gives us the answer. Anytime you're asked, what is the auditor trying to achieve? ISA 200 gives you the what? The
The
answer.
answer.
And this is not just theory. If you cannot articulate the audit objective, you cannot design a plan to achieve it. You cannot.
Sorry sir, for interrupting. The other person have message on WhatsApp that he cannot get the link.
Okay, let me copy that link and drop for him. Then you know what? I think this is less 1 minute. So let me end it. Rejoin again with the link.
Okay, sir.
So that he will not be cut off.
All right, sir.
Okay. So I was saying before now that before we plan anything, we must know what we are planning for.
Yes, sir.
What is the auditor trying to achieve? And I said there is a standard that gives us the answer. That's ISA what? 200.
200.
And I said that it is not just theory. You must be able to understand it, because if you cannot articulate the audit objective, you cannot design a plan to achieve it. So,
Okay, sir.
so if you're writing, you can write ISA 200 is about the auditor's objectives. ISA 200, auditor's objectives.
Okay.
So in audit, it is always the foundation of auditing. The reason is because it explains the overall objectives of an auditor. When something starts from the objectives, that's foundation already, because objectives are like, the things you're to do, right? To
Yes, sir.
achieve a goal. Exactly. The basic principles that guides an audit. When we look at what it means to conduct an audit in accordance with these standards, that's ISA 200.
200.
Yeah. Are you there?
Yes, I'm with you, sir.
Okay, so ISA 200 is trying to say what is the auditor trying to achieve and how they behave while doing the audit.
Can you recap that, sir?
Is the auditor trying to achieve, and how do the auditor behave while trying to achieve that objective? So that's why I was saying, in simple terms, it's all about the auditor's objectives. The objectives of an audit. ISA 200. Now, the objectives of the auditor are two. Are you with me? We classify them into
Yes, sir.
two. The objectives of an auditor. The first objective of an auditor is to obtain reasonable assurance. To obtain reasonable assurance to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatements. I'll take it again. The first objective of the auditor, in accordance with ISA 200, is to obtain reasonable assurance about whether the financial statements as a whole are free from material what?
Misstatement.
Misstatements. Whether due to fraud, whether due to error. The first objective is to obtain reasonable what? Assurance.
Assurance.
By the time the auditor has known that, oh, this is my first objective, it will enable the auditor to express an opinion on whether the financial statements are prepared in accordance with the applicable financial reporting framework. Because there is a framework. Do you understand?
Yes, sir.
The second objective is to report on the financial statements and communicate as required by the ISAs in accordance with the auditor's findings. So, if the auditor cannot obtain reasonable assurance and a qualified opinion is insufficient, the auditor must disclaim an opinion or resign, because it means he has failed. Do you understand, Ms. Taiwo?
Yes, sir. Yes, sir.
That this is important. It's important. You need to take notes. Any auditor that cannot obtain reasonable assurance and a qualified opinion is insufficient, that auditor must do what? Disclaim an opinion,
Sir.
or what? Resign. Because ISA 200 have provided the objectives, that your first objective as an auditor is to obtain reasonable assurance about whether the financial statements as a whole, we are not removing any, are free from what? Material
Material
misstatements.
misstatement.
Whether due to fraud or error. Do you understand?
Yes, sir.
Now, let me break down 3 critical phrases in English. We have what we call phrase, right, in a sentence. Let me break
Yes,
down
sir.
these 3 critical phrases from this definition, because students used to have issues in exam. They will not know. When they ask them, what do we mean when we talk about reasonable assurance? They are confused. They don't know how to apply it. Because
Okay,
as
sir.
far as this chapter is concerned, these phrases you're seeing here, phrase number 1 is this one, reasonable assurance. Number 2, material, this material misstatement, not statement to misstatement.
Misstatement.
Yes, misstatement. Misstatement. And fraud or error. Very important. Fraud or error. You must
Okay.
know them. Yeah. So for the first one, reasonable assurance. This one, reasonable assurance. What does it mean and why does it matter to us as auditors? What reasonable assurance means? It means it is high but not absolute level of assurance, like not 100% certainty. Do you understand?
Yes, sir.
You know, when conducting audits, there are a lot of evidence is needed, right?
Yes, sir.
So what justifies why audits use those evidence, use those samples, those sampling, not just to just conclude? That's the aspect of reasonable what? Assurance.
Assurance.
So it justifies why audits use sampling, not 100% testing alone. When we talk about misstatements, material misstatements, this is simply an error large enough to influence the economic decisions of users. I'll take it again. Material misstatements means an error large enough to influence the economic decisions of what? Users. The reason why it is important is because we need materiality. We need it. We need materiality thresholds. So it's important. When we talk about fraud or error, you know what fraud is?
Yes.
An intentional or
Intentional acts.
unintentional error or misstatement. The same thing with error
Mhm.
too. Something that
Yes.
can be
Yes.
intentionally done. People make a mistake intentionally. Some we do it
Yes.
unintentionally. It's still
Mhm.
error. It's still fraud.
Okay.
Both of them requires the auditor's attention, right?
Yes, sir.
We will not say, oh, this one is nothing is minor. They both requires the auditor's what? Attention.
Attention.
So ISA 200 has a requirement. And what is the requirement? It requires that the auditor must comply with all the standards relevant to the audit. If I write it, because exam they used to ask, the first requirement, write it under as ISA 200 requirements. ISA 200
In
requirements.
200 requirements.
Yes, ISA
Okay.
200 requirements.
Mhm. Okay.
The first requirement is that it requires the auditor to comply with all ISAs relevant to the audit. The second again is to comply again with relevant ethical requirements. To comply with relevant ethical requirements. Number 3 requirements is that the auditor should plan and perform with professional skepticism. ISA 200 requires the auditor to plan and perform with professional skepticism. The number 4 requirement is that it requires the auditor to obtain sufficient and appropriate audit evidence. To obtain sufficient and appropriate audit evidence. Now, you go and do research, take notes of these words. The other word I mentioned called skepticism is very important. Professional skepticism and professional judgment. Because most times in the examiner expects you to demonstrate this in your scenario-based answers. So in your scenario-based answers, you don't just go and write the auditor to comply with relevant ethical requirements, or okay, the auditor to plan and perform professional. You write it.
Skepticism.
Don't write it alone. The exam for you to get your full mark, there's the examiner We'll be looking at this as grammar, right? So
Yes.
he expects you to do what? That you should not just state them, but rather you demonstrate them in your scenario-based answers. Questions that are scenario-based. We'll look at them in the course of this. Are you there? Now let's look into
Yes, sir.
why do we need a plan? Now that we have known the objectives of an audit, why do we now need a plan? Because we are looking at planning, audit planning. So where does planning come in all of this? Why do we need to plan? Why do we need a plan?
Okay.
Why do we need a plan? Now, there is a standard for this, ISA 300. Now, let's be more realistic. If you were traveling from Lagos to Abuja, Miss Taiwo,
Yes, sir.
for the first time by road, if you were traveling from Lagos to Abuja for the first time by road, would you start driving and figure it out?
Uh, no, I'll first ask about the journey first.
Exactly. You will plan your trip, right? You
Yes.
will ask questions first. If you're traveling next week and you know you want to drive yourself from Lagos to Abuja, you start by asking questions. You
Yes.
estimate the time. You check fuel. Find out, ask question, oh, okay, how many liters of fuel will it take? So your car don't go and stop in maybe in Ore or one place and you don't have, you understand?
Kogi.
Or hey,
Yes.
Kogi. Eh? Look, you understand?
Yes, sir.
You identify the rest stops. You know, I've traveled most times by road. There are times we'll stop some in a restaurant, say we stop, you go and eat, right? Yeah. You two will
Yes.
ask some drivers before you even start that trip. If I'm tired, where will I rest? Where will I stop? Audit is the same. Oh.
Yes, sir.
This same way of this trip now, that's how audit is. And ISA 300 mandates that we plan every audit engagement. You see, before you embark on that trip, since you know you want to drive yourself, you have started making, asking questions. That's how audit engagement is. Do you understand? So ISA
Yes, sir.
300, write this down. ISA 300 is about the planning requirements. ISA 300 is about what? Planning,
The planning.
planning requirements.
Um,
ISA 300, planning requirements. What does it now require? Since it provides all the requirements, what exactly does it mandate that the auditor must do? ISA 300 requires first an audit should be planned so that it is performed effectively. Are you hearing me?
yes, sir.
It requires that an audit should be planned so that it is performed what? Effectively.
Effectively.
Number two, ISA 300 requires that the auditor must establish an overall audit strategy. It also requires that the audit plan must include measures for the direction, supervision, and review of audit work. IC 300 requires first that an audit should be planned so that it is performed effectively. IC 300 again requires that the auditor must establish an overall audit what? Strategy.
Strategy.
And it requires again that the audit plan must include measures for the direction, supervision, and review
Solution
of
review
audit
of
work.
the work.
Now, when we look at a plan, what is a plan? We always say it, a plan is a course of action, right?
Yes, sir.
Decided in advance to achieve a stated goal or objective. We can always come up with different definition of a plan. But yeah, the planning process is what enables the auditor to apply professional judgment to the specific circumstance of each audit. I was sharing with you when we started about the audit firm where I started my career, Benga Adeoye and Co. Chartered Accountant, right?
Yes, sir.
And, you know, from my findings then, I discovered that most professional firms, most professional audit firms document their planning decisions. Are you hearing me? They document their planning
Yes, sir.
decisions. We document it back then. You see us, we always document our planning decisions in what we call an audit strategy memorandum.
Audit report
Strategy
memorandum.
memorandum. You can write it. Most professional audit firms document their planning decisions in what is called an audit strategy memorandum. And this audit strategy memorandum is your master planning documents. Are you getting me? It is your
Yes, sir.
master planning document. In an exam scenario, if you are asked what should be included in an audit plan, they will ask you that question. What should be included in an audit plan? Sometimes it will be integrated in some
Audit.
questions. What should be included in an audit plan? This is your answer. Do you understand?
Yes, sir.
In case you're asked, what should be included in an audit plan? What is your answer?
Audit strategic memorandum.
Memorandum. Because inside it is all the plans. Do you understand?
Yes, sir.
In fact, let me share with you the content so that you now understand why this audit strategy memorandum is important. Why in audit firms, we don't joke with it. We document our planning decisions. We can spend hours. We spend hours. We are doing that. So you can write contents content in the audit strategy memorandum or content of this audit strategy memorandum. Contents. There are 10 contents I want to give you. 10 key areas.
Yes, sir.
Let me know if you're ready to
Okay,
take
sir.
it. Are you ready?
Sir. Yes, sir.
Okay, number 1, assignment objectives. Assignment objectives and reports to be issued. Number 2, the audit timetable. Now, this audit timetable contains deadlines for the auditor's reports. Number 3, changes in the client's organization, business, or external environments since the previous audits. Number 4, summary of key financial ratios from previous years. Now, this summary of key financial ratios from previous years is what we used to call trend analysis. Because at that point, you're trying to do
Yeah.
like a comparison,
Comparison.
2024 versus 2025. Exactly. Another content is planning decisions. So it also contains the planning decisions for the audit. It's
Okay.
inside this part now of that document where you will have things like the strategy we are adopting, the approach we are adopting, the risk response. These are embedded there. Then we also have we also have use of client staff. For example, internal auditors. You know, the internal auditors belongs to the clients, right?
Yes, sir.
So most times we state it there that we will need to use, the internal auditors, the client staffs.
Okay.
So you can put it, e.g., internal auditors and external experts. Sometimes external experts too are needed. Could be for forensic or any aspect. Then
Or
number
for
7,
valuation.
you say?
I said all for valuation.
Or for valuation, thank you. Number 7, possible problem areas and the approach to deal with them. So these two have to be captured. Staffing requirements. Staffing requirements. Time budgets and previous audit records. Number 9, attendance locations. Attendance locations for clients with multiple branches or sites. There are some clients that have multiple branches and sites.
Yeah.
So you need to capture the locations, names of those locations. Then, lastly, proposed methods of communication with the clients. Proposed methods of communication with the clients. Now, you remember that first illustration we looked at when we started about Dangote, when I was
Yes.
asking you that
What is the
imagine,
first thing?
imagine you are the senior audit manager at a big four firm in Lagos, and your partner walks in on Monday morning and says, Miss Taiwo, we just signed Dangote Cement as a new audit client. The engagement partner is traveling. You have 3 weeks before field work begins. And I ask you, what do you do first? And you mentioned some areas, right?
Yes, sir.
Understanding the business, reviewing last year audit file, meeting the client's finance director, check for independence and all that. Good. Now, let me ask you, still on that Dangote, now let's look at Dangote Cement. Suppose,
Okay.
suppose you are auditing Dangote Cement PLC.
Okay.
Your audit strategy memorandum. Hope you know that. What do you think your audit strategy memorandum should note? Based on what do you
Mm,
understand by audit? Tell me, what do you understand by audit strategy memorandum first? Based on what we have just done. Just explain. Let me just be sure. Like you teach me now. What if you're explaining to someone and they say audit strategy memorandum? Tell me.
The audit strategy memorandum is talking
Mhm.
about what should be included in the planning,
Okay.
like the assignment objective and the report to be issued. Like what is the auditor's objective he's trying to achieve in this audit engagement. Then the audit timetable, like what's the time frame of
Okay, beautiful.
completing. Yes.
Beautiful. Beautiful. You understand it. Are you with me?
Yes, sir.
Now, I want you to apply it. Let's say we're engaged to carry out an audit assignment with Dangote Cement, and you now, Mr. Taiwo, is to audit Dangote
Yes, sir.
Cement PLC. Can you tell me three things that your audit strategy memorandum would note based
Okay.
on the content? These content are just like
Yes.
guidelines. So I mean, now I want to hear what will be your assignment objective. Like pick it from Dangote scenario now as a company. At least Dangote is popular company now. When we talk about the cement,
Yes.
you know what they do in the cement. You know now things that run their cement. At least you understand from
Okay.
what we have been hearing. Cement business. So if you're to audit Dangote Cement PLC with your understanding of the audit strategy memorandum, what are those three things you would note?
Okay. Like I'll first note the planning decision for the audit, the strategy, the approach,
I
and the
want to
risks
hear, I
associated
want
with
to now
it.
hear
Yes.
those things now. Okay, let me give you an example. Eh? Let me give you an
Yes.
example so that you know the why I want the answer. If you remember our number nine, we said
Attendance.
that it should contain attendance location, right?
Notification. Yes.
For clients with my hair good. So for Dangote Cement PLC now, if I am auditing, one of the things my audit strategy memorandum will contain will be the number of location the company has
Notifications.
in
Mm.
Nigeria. Are you seeing? So
Yeah. Yes.
instead of number nine, me writing attendance location, I will put Dangote Cement has 14 plants across Nigeria and are in 10 African countries. Are you seeing now?
Yes.
You see that talks about their what?
But
Location.
the locations.
Exactly. Their branches, right?
Yes.
So tell me another one now that you can actually apply. Maybe any of these aspects for that same Dangote cement.
Okay. I'll ask about the internal auditors because they will be the ones to give me light on what the business is all about.
Mhm.
Right? And
Yes.
the method of communication, maybe we are going to communicate through online, or it will be like a field work that I will go there to the each location.
Mhm. Very good. Also, we can also look into when we look that okay, when we also look into the aspect of changes in the client organization. Are you seeing that?
Yes,
That one means that tell me, how will
they
you
have
answer that
changed.
one?
Okay, I want some. Maybe they have already changed
You
um the CEO. Maybe according to
uh-huh.
the meetings,
Mm-hmm.
the annual audit, the annual meetings, the
You go and do
AGM, like
research, right?
AGM. Maybe yes, yes.
Mm-hmm. You see now that you must be wide. You understand? So in that place now, you can tell us the company is listed on the NGX. Are you seeing?
Mm, yes, sir.
You don't go and be running around the bush. What is needed is direct. If the company have
Okay.
meshed up with another company, just state it in that number. See, these things, if you remember what we said, this audit strategy memorandum is, we said it has to do with the planning decisions.
Yes,
Do you understand?
yes, sir.
The company is listed on the NGX. A new 200 billion plant was commissioned in One, River State during the year. These things are important because if we talk about risk response now, it's important because if a new plant was commissioned, it could create inherent risks. Remember, I mentioned three risk areas. Do you remember?
Yes,
Inherent,
yes,
right? Control,
yes,
detection.
yes. Control and detection.
It could create inherent risks around the capitalization and depreciation of assets. Every one of these would go into the audit strategy memorandum before your team will now set their foot in the client's premises. You must have, first of all, gotten all this answer. Do you understand?
Yes, sir.
Do you have any question?
No question for now.
Okay, but you understand now that before we step our
Yeah.
feet in Dangote cement, in our
Mm.
office,
Must
we must have
understand
done what? We must have gotten all
our
the response to all this.
yes.
Oh, we discovered also that the cement industry is now highly regulated by SON and maybe NROS, formerly FIRS. So changes in regulation since last audit must be flagged. These are things that could come into. We find out the auditors deadline for the auditors reports. We'll look at possible problem areas ahead of we have already. So now the next aspect we are going to look at here, the next aspect we are going to look at here is on the aspect of the audit risks model.
The audit risk
The
model.
audit risks model, yes. The audit risks model. Now, you must note this, the entire audit process is a risk management exercise. Everything the auditor does, from planning to reporting, is designed to manage one thing, and that is the risk of expressing the wrong opinion. Do you get me?
Yes, sir.
You cannot talk
The
about
risk of
the
expressing
risks
the
of
wrong
expressing the wrong opinion. Everything
opinion.
the auditor does, from planning to reporting, is designed to manage that, the risks of expressing the wrong opinion. It's very important aspect as auditing is concerned. And the tool we use to manage that risk is called the audit risk model. Do you get that?
Yes, sir.
Good.
And the tools that we use to manage the risks.
It's called the audit risk
of
model.
audit risk model.
So you can write down, what is the audit risk model? What is
Okay.
audit risk? First of all, what is audit risk? Now, audit risk is the risk that the auditor
Mm.
reaches an inappropriate conclusion.
Is the
Audit,
risk.
audit risk
Okay.
is the risk. Now, risk here we
Mm.
call chance that the auditor reaches an inappropriate, which is this in this case wrong conclusion on the area under audit. By audit risks, we are referring to the risks that the chance that the auditor reaches an inappropriate conclusion on the area under what? Audit.
Audit.
Let me give you an example. If, are you with me?
Yes, sir.
If audit risk is 5%, The auditor accepts only a 5% chance that an audited item is materially misstated in the financial statement.
I didn't get that, sir.
If audit risk is 5%, the auditor accepts only a 5% chance that an audited item is materially misstated in the final financial statement. It's not a question, I'm just showing you an example, what the auditor will do.
Yes.
Do you understand?
Yes,
Now,
sir.
the audit risks, in audit risks, we have a formula. You check in your ICAN textbook, is there, the audit risk formula. Okay, so the formula is given as this, so you can write it to the audit risk formula. So the audit risk formula is given as audit risk is equal to I arrow, that's this for inherent risks. I will explain it. I arrow, I'll break it down. I arrow, C arrow, D arrow, where A arrow stands for audit risks, I arrow stands for inherent risks, C arrow stands for control risks, D arrow stands for detection risks. Now, there is a way we express risks. So, yeah, risks are expressed as proportions. Risks are expressed as proportions.
It's proportion.
Yes. For example, what we mean is this. A risk of 10%, take for example, a risk of 10% will be equal to 0.10.
Sorry, sir, I'm not seeing your screen again. Can you please come down?
Oh, sorry. Can you see it now?
Yes, sir.
Okay, so I was saying that risks here are expressed as what? Proportions.
Sure.
And that a risk of 10% is equal to 0.10 in the what? Formula. A risk of, if we have a risk of 25%, it will be expressed as what? 0.25
It's so fine.
in the what?
Yes.
Formula.
In the formula.
Do you understand?
Yes, sir.
Okay, let me give you an example instance to look at this so that you will not forget this formula. You see this formula up here? You need to remember this formula at all times. Very important for your exam.
Okay. Yeah,
Think
I'm
of,
focused.
yeah, think of washing, think of a washing line outside a house. Maybe during Hamatan, people wash outside, right?
Yes.
Maybe there is maybe you hang your clean clothes on the rope. Maybe there's a rope where people hang their clothes. You hang your clean clothes. Do you understand what I'm saying?
Yes, sir.
I want to explain this formula, these three rigs for you.
Okay.
We're in Hamatan season or sunny period. People are washing clothes. They have a rope they tied in the compound where they spread the clothes. So you wash your own too, you spread your clothes on, hang it on the rope. That your clothes now, look at it as the financial statement. That your clothes that you hang on the rope, look at it as what?
Okay.
The financial
Financial
statement.
statement.
Good. Now, inherent risks is how dirty, is when we are now looking at how dirty is the air. Do you know that there's a way the air can be dirty? It can stain down your clothes.
Yes.
Especially, let's say, if where the rope is close to an express road where motor vehicles are passing. You know that there's a way truck can pass and,
Yes.
start bringing out in the
Yes.
exhaust and it can stain your clothes. So in inherent risks, we look at how dirty is the air in such scenario. Some areas have more dust, especially if the your house, the compound is close to construction sites or a chemical plant. You know that the clothes will get dirty too, regardless of what you
Yes.
do.
Yes.
This is the nature of the business. That's where we look at the nature of the business. Do you
Okay.
understand?
Yes, sir.
By inherent risks, we are looking at the nature of the business. That the fact that you have understood that, oh, certain type of business is exposed. Oh, if somebody is not there by so time, there's every probability that something must can get missing. If there's no CCTV camera there, or even if there is, but this. You understand? That tells you
Yes.
the nature because you're spreading a cloth in an environment that is close to a chemical plant. How can you prevent it from getting
Mm.
stained? That all one will get stained. You understand? It's not possible now.
Yeah. Yes.
This is a construction site. They are building. People are building, people are walking, people are passing by, and you spread a cloth on the rope. By control risks, now is where we are asking a question like, does the house have a roof or fence protecting that rope? Somebody might ask, okay, we can actually prevent it from staining. How? That's where control comes. And that's okay. If they have a fence, because you have to look at it, if the house have a fence, don't you think that divides somehow, the compound from um the chemical
Mm.
plants or
It
the
does.
you
It does.
understand?
Yes.
So fence is like a good control, right?
Yes.
Which means because there is fence close to the rope, that's good control. The dust is less likely to reach the clothes. But
Includes.
if there is no fence, that's weak control. So you now bring this to an organization. That's an answer that we look at. What control measures have they put in place? If the control is weak, there will be more what? Exposure.
Exposure.
Detection risks. After the clothes have been hanged, you personally go to check them yourself. That's detection. You go to detect. When you go, you carry it, you check. You check if it has dried or you just check and you go, you come back again. You understand?
Yes.
Detection risks is the chance you fail to notice the clothes are dirty, even when you are looking at them. That's detection risks. You are looking at the clothes. One is dirty. We could not detect it. So the auditor cannot control the weather. Can the auditor control the weather?
No.
The issue of air that because it's close to a chemical plant or construction site, can the auditor control
Yes.
that one? Can the
No.
auditor control it? No.
No.
Imagine taking a business like a bank to a ghetto or an area where there is possible attempts for bandit attack. Can the auditor control such inherent risks?
No.
No. What the auditor can do is to advise on the control risks. That's what he can do on the fence. But he cannot change it. You understand?
Yes, sir.
The only risks the auditor can directly control is detection risks. And how does he do that? Detecting, doing more thorough testing. Do you understand?
Yes, sir.
So before we wrap up this lesson, right? Inherent risks. Let's take the definition. Inherent risks. Inherent risks. Have you taken that down?
Mm. Yes, sir.
Inherent risk is the risk that items may be misstated. Inherent risk, we say, is the risk that items may be what? Stated
Misstatement.
as a result
Misstated.
of their inherent characteristics, which is independent of any internal controls. Inherent risk is the risk that items may be what? Misstated as a result of their inherent characteristics, independent of any internal controls. Key features of inherent risk. Inherent risk cannot be controlled by the auditor. Like we said, the auditor must accept it, exist, and plan accordingly. Inherent risk arises from two sources. There are two sources it arises from. So the rest of the lectures, I'll provide them as continuation of the video records. So
Okay.
inherent
Okay, sir.
risk arises from two sources. Source A, the nature of the items themselves. For example, where we have estimated figures, when we have complex transactions, where we have subjective valuations, and the nature of the entity and the industry it operates in. These are two sources inherent risks arises from. The nature of the items themselves, estimated figures, complex transactions, subjective valuations, and the nature of the entity and the industry it operates in. Now, the auditor assesses inherent risks at two levels. There are two levels an auditor assess inherent risks. And you need to take note because it also comes in exam. There are two levels auditor assesses inherent risks. The first level, the first level is the financial statement level. The second level is at the accounts balance or the transaction level. Now, when we talk about the financial statement level, here, what the auditor does, he looks at the integrity aspects, skills, the abilities of management. He looks at the nature of the business in this level. High risk versus low risk industry. Is it where the business is? He looks at the industry-wide and macroeconomic factors. Inflation, for example, regulation that could affect that business. He looks at management incentives to misstate? Are there bonuses tied to profit targets? But when it comes to the account balance and transaction level, he looks at the degree of subjectivity in the balance. For example, he looks at things like provisions, estimates. He looks at the complexity of the transaction and how the transaction is processed. He looks at the nature of the client's assets and risks of misappropriation. He looks at the volume of transactions in the accounts. Are there high volume? Because high volume will lead to higher inherent risks. Now, let me share this scenario with us. It's Taiwo, I don't know if you can still hear me. Answer.
Yes, I can hear you.
Okay, I want you to identify inherent risks. Okay? You identify many
Okay, sir.
inherent risks as you can through this scenario I want to share. It's what we always use in our classes, previous class too.
Okay.
Zenith Constructions Limited builds residential estates across Lagos. Exam question.
Zenith.
Zenith Constructions Limited builds residential estates across Lagos and Abuja. We are told that the company's managing director owns 65% of the shares and is due to sell 20% of his stake to a foreign investor next month. The company uses the percentage of completion method for revenue recognition on all contracts. Three of its largest projects are running 8 months behind schedule and over budget. The company carries large amounts of work in progress inventory. Its year end is 31st December. Question. List all the inherent risks. Because I'll still give assignment after this one. List all the inherent risks. You can identify from this scenario. Okay, so over to us. Based on what we have understood about inherent risks. So, Ms. Taiwo, give a
Ah,
try. Let me read this question again. Zenith Constructions Limited builds residential. In fact, before we do that, let's go back again. What did we say inherent risk is? We said that inherent risk is the risk that items may be misstated
maybe misstated.
as a what?
As a result of their inherent characteristic,
Independent of any controls, right?
external country.
And
Yes.
we said there are key features of inherent risks. I said it cannot be controlled by the auditor.
It might be.
The
Yes.
auditor must accept that it exists. and plan accordingly.
Yes.
And we also said that inherent risk arises from two sources: the nature of the items themselves, the nature of the entity, and the industry it operates in. And that there are two
Yes.
levels. The auditor assesses inherent risks at two levels: financial statement level and account balance level. Back to the question. Zenith Construction Limited builds residential estates across Lagos and Abuja. The company's managing director owns 65%
Recording in progress.
of the shares. Can you see that?
Sir, please, I want to log in on my phone.
Okay, no problem. If you've logged in, let me know.
Okay, sir. I've logged in.
Okay. So the company's managing director owns 65% of shares and is due to sell 20% of his stake to a foreign investor next month. The company uses the percentage of completion method for all revenue recognition on all contracts. Three of its largest projects are running 8 months behind schedule and over budget. The company carries large amounts of work in progress inventory. Its year end is 31st December. List all the inherent risks you can identify from this scenario in style.
Okay, sir.
Tell me one risk you identify.
Okay. I'm trying to digest the question.
Okay.
Hello, sir.
Yes.
Yes. Yeah. In this area of the managing director owning 65%,
Okay.
and he owns the shares and at the same time is the managing director.
Mm-hmm.
There's a that means in area of governance, he
Mm.
will manipulate some certain,
Mm.
especially in the area of shares to a foreign investor.
Mm. Because he
But
owns
yeah,
65%
of the
and
shares
he's
of the company.
and he's selling the shares next month.
Mm. Then another area again about the gap in progressive in
The gap in what, sir? So hello, sir. So that first one you talked about, we can call it management integrity risks, since due to the fact that he's the manager, he can inflate it. He can inflate profit just to convince the foreign investor. Mr. Iwo, did you get what he said?
No, sir.
Okay, he highlighted one of the inherent risks. I think he's having network challenge. He highlighted one of the risks now. Sir, are you there? Mr. Iwo, can you hear me?
Yes, I can hear you, sir.
I know that you're still thinking. You will still answer. So, because there are many risks here. See the first risks. We are told that the company's managing director owns 65%
Yes.
of the shares.
Okay.
There is no problem with that too. It may be that he's the founder. He can own
Yes.
65%. And he wants to
Okay.
sell 20% or out of his own stake to who? A foreign investor next month. That
Okay. You need
that's
the
eh?
economic factor. I said you need to consider the economic factor.
But this one first has a management integrity risk. Is it meant to sell? Because you understand, because since he's selling now,
Yeah.
he is going to, there's every tendency that he can inflate profits. That's what Sautu was saying. He can inflate the profit to attract better valuation. He can overstate revenue. Maybe that month they made, because this in foreign investor now, before foreign investor would want to buy this stake, he will request for the financial statements. You understand?
Yeah.
And this man
Yeah.
here, this managing director now, can manipulate it. That's what Sa was saying. That he can manipulate it. If they have not been doing well, he can manipulate it and increase the sale, the revenue. He can say they made 50 million, whereas they did not. So that brings an inherent risk of management integrity risks. So if it's in ICAN scenario, the way you explain it, you can draw a table for them. First column, scenario detail. See how people will do it
Okay.
like this. To answer that question now, I can put three this. Okay. Then column 1, scenario detail. This is how you get your complete mark. Scenario
Okay.
detail. This is solution. So first scenario now from that question now, like the one Sarah pointed out. What's the scenario? This is how you do it. So you say MD owns 65% and he's selling shares next month. Now, this is the inherent risk. We said the inherent risk here is that management integrity. There's management integrity risks. Incentive to inflate profits to attract better valuation. Yeah, you now highlight the potential misstatements that could occur. So start to think of those things that can be done. We said revenue overstated. Liabilities understated. You know what these liabilities all mean? If the company is owing debt, they
You to
understate it.
reduce.
Exactly.
So
You understand?
they'll be they are on safer side.
Exactly. That's a risk. Yeah? You now make the person now who wants to buy, he will go and buy, and at the end of the day now, now find out that the company is struggling. Does that make
Sorry,
sense?
sir, my network,
Okay.
Yes, sir.
Sorry. That does not that
network
does
went
not
off.
tell good. So, sir, you were saying you can go on, sir.
No, you think already, at least a few points I was able to read.
I did not get the
Maybe you
second
can
point.
work on that one. You can use that one if I'm
We did not get the second point.
okay. The second point that when you say the company uses the percentage of completion method, I don't really on revenue recognition on all contracts. I don't really get that point. But the area I was looking at, you said the project would last. It has been
Eight months
as the
behind.
project has been behind for. So if such, I think inflation would definitely comes in because in every project there is always a budget line
Exactly.
for each project. So for so long, it will definitely affect the the outcome of the project in terms of financing it because of inflation. That would definitely swallow most of the money that have been budgeted for such a project. leaving it for so long, it will affect the budget generally. And that will also warrant the organization to also look for alternative means of completing such projects, which will actually affect the organization at the end. And that is the area I'm going to. That is what I think. So since it's a case study, I just brought in that. But if there's other better answer, you
Okay, sir.
can.
Okay, thank you, sir. So that's actually a risk that's a risk you identified. That's a good risk that you actually identified there. Then another aspect we would also look at is here, where we are told that the company carries large amounts of work in progress inventory. So that is also another aspect too, because there will be overvaluation, and the work in progress could be overstated if the cost is incorrectly capitalized at the end of the day. Then we can also look at the industry in particular. This is a construction industry. And there are other risks too that also comes up within such industry too. As for the projects, there must definitely be budgets for it. And why they have told us that 3 of its largest projects are running 8 months behind schedule and over budgets. That's a risk. The inherent risk is the budget overruns, and that would eliminate expected profit margins. Now, if we talk about percentage of completion method for revenue recognition on all contracts, we are more concerned about the revenue and profits if it is misstated. So,
Okay.
some inherent risks can actually be detected in the Nigerian business environment. And one way you can detect it, you need to take note of some. There are some that we know that must exist. For example, the aspect of foreign exchange risks. Companies with USD denominated transactions face high inherent risks due to Naira volatility. Sometimes we look at receivables and payables in foreign currency will require careful translation, especially under IAS 21. Then other industries like oil and gas, telecoms, complex contracts there too, needs proper consideration to be made with IFRS 15 on contracts with customers. Inventory valuation is also important for trading companies. In case it's a scenario that's with trading companies, inventory valuation is another aspect, like you made mention of high inflation. So high inflation, importation challenges, tax, port clearance, duties, inventory costs, because if this is 8 months behind, inventory price and all that, even their previous estimates that they did have already been affected by all this. So inventory costs are difficult to precisely determine. For small businesses, medium businesses, going concern is an issue for them, because even with access to finance, accessing finance is actually a consistent challenge that many small companies have inherent going concern risks that must be flagged also during the planning process. So all these are very important, very important. So we do the remaining parts, I will add it with this, because we still have to look at control risks. We still have to look at detection risks. These are all very important. Then you now look at the audit risks. Remember, this is under audit risks. So continue study
Yes.
too on your textbook, because we now need to look at how do they connect. Remember, what brought us to this part was actually when we look at the formula of audit risks, that audit risk is equal to inherent risks times credit risk times the detection
Definitely.
risks. So you now look at how they connect. Now look at how they connect, and you must know, because if inherent risks times control risk is high, detection risk must be low. So in our next meeting, so we'll look at this. If that's I'll try during the week. We'll have a class maybe on Tuesday. So I'll look at it, because there are